Okay, so this last piece, we're just going to talk about analyzing changes in sales from expected amounts. And so a similar analysis we can do is there's two additional Gmax products. We have golf balls and drivers. And so we budget 1,000 units of golf balls, but our actual is more. We have a sales price, we have the units of drivers and the sales price of drivers. And so we can look at sales in a similar framework. We can look at our actual sale times our actual price, our actuals times our standard, our budgeted sales times our budgeted price, then make our actual sales times the budgeted price. And we can figure out if we are having favorable sales price variances or sales volume variances. And so either one of these, we can break them out and we can determine it as a group or we can determine it as a product stream. This is the exact same concept as direct materials, direct labor. So I'm not going to spend too much time on it. You can just look at this yourself and get an understanding here. And so we're saying here, we can look at, if we look at sales dollars from balls perspective, the balls, the $550 price variance and $1,000 favorable volume variance. So we're selling more and we're making more and we're selling them for more. But the drivers, we're selling less by $1,000 and we're selling them at a less of a cost than we want. That's how we can drive in and analyze. We don't want to just analyze costs. We can also analyze sales and figure out which sales are more productive. So from a business perspective, we can say here and say, hey, well, let's focus on selling golf balls. They seem to be doing pretty well. Or let's raise the price on them or raise the marketing. Or we could say, hey, our drivers as profitable as we want, why are the sales down? Maybe we need to rebrand or make a new product. Learning objectives, compute overhead spending and efficiency variances. So this I'm going to go over. This is also complex. We went over the budgeting aspect of the overhead variances. This is an appendix, not a requirement so I won't be testing you this on your final, but I'm just going to cover this quickly so you're aware of it. This will be more on cost accounting. So just be aware there's actually a whole other bucket of overhead variances that we can use to determine if we have a spending or efficiency variance for overhead. I'm going to walk you through it quickly from a high level, but I'm not going to go into the calculations other than just show you where they're played, because you might have some on your homework. Like I think I put one on your homework just so you're familiar with it. But ultimately, you're not going to be tested on this on your final, but you will have to know it for your cost accounting if you stay in accounting. So total overhead variances, we talked about the budgeting problems before, but now we're going to talk about what if we expanded the total overhead variance to think about variable overhead variances and fixed overhead variances. And so this is just a different way to think about the variances. And we've talked about what are controllable variances versus non-controllable. So previously we talked about the fixed overhead variances, and of the fixed overhead variances, we talked about the volume and the spending. But I want us to, actually I think before we talked about specifically controllable and volume variances. But today this section, we're going to be talking about the variable and fixed overhead, if we were to break it out by that component. So variable overhead variances, we can break out the concept of overhead, not just from a grouped amount into these fixed and variable components. The variable component would have something similar to labor, where we have a spending variance and an efficiency variance. And it's the actual variable overhead incurred versus the actual amount of overhead hours compared to the actual amount applied at the overhead standard rate. And so again, there's this complexity here of what we have applied, the applied concept versus the actual concept, and then the flexible budget for variable overhead versus actual hours. And so we'll go through an example just so you can do this yourself and watch this video to catch up with it. Again, not going to spend too much time here as it's more of a cost accounting concept rather than managerial accounting. So let's say variable overhead variances for GMAX. Similar fact set, we'll go back and forth. So what's our actual variable overhead incurred? We can go back here. It says that. That's always given, right? Actual is an actual, 3,650. So we know where that information is. Flexible budget for variable overhead, we need 3,400 times $1. So we're saying our flexible budget said we produced heads working 3,500 heads working 3,400 hours. So 3,400 hours is there. 3,400 hours is there. And then we saw from an earlier rate card that we expected to be $1 per hour. So that's $3,400. And that's referencing the rate card above, the standard direct labor hours. And then what's our applied variable overhead? That's the difference here. Applied, I'll underline it, versus our overhead standard rate. So standard rate stays the same, but what's our applied amount? Well, we applied 30 against 3,500 hours, right? We're assuming that it'd be 1 hour per unit. So 3,500 units is 3,500 hours, even though we worked 3,400 hours. And we apply it, we from a flexible budget perspective, we allocated on 3,400, but we applied at the 3,500. And so we can determine a spending variance and an efficiency variance here. So we spent $250 too much. So we spent more on our overhead than we initially anticipated, but we used less overhead than we anticipated as well. So then we used less than we applied. That's a thought here. So we did a very similar exercise to what we did for what I call direct labor hours. Then we do the same thing for fixed variances. We accept a spending variance and a volume variance. And so actual fixed, budgeted fixed, and applied fixed. Actual, we know this is always given. Applied, again, this is applied at the estimated hours. And then we have this budgeted amount again. So let's just go over a quick example so you have it for reference. Fixed overhead variances. So we're saying actual is always given. We know we spent actual of 4,000. That's easy. So that should always be your easy answer. Applied, 3,500 times 1. We know we had 3,500. And we know from our earlier presentation that we were applying it at a rate of $1 per overhead. And then our budgeted fixed overhead, 4,000 units. So we budgeted an hour, a $1 per unit. So that's where we get our $4,000. So we can see that we don't have a spending variance, but we applied too little, right? So we have a volume variance where we applied less hours than we should have based, and this is purely an accounting estimate issue, that we applied less units of fixed overhead than we thought we were going to apply. We thought we were going to apply 4,000 units, but we didn't. And so this is just a chart to see it. We expected fixed overhead costs to be 4,000, but we only applied 3,500. So that's just saying what I said earlier, which gives us our volume variance. And so here's another way to look at all the different types of overhead variance that we can calculate. Right, we talked about variable overhead variance, fixed overhead variance. This is just comparing actual overhead to actual variable overhead to actual applied variable overhead. This is comparing actual fixed overhead to applied fixed overhead. And then the first one we did was actual overhead to applied overhead, total overhead, which gives us the controllable variances we talked about. So the overhead variances can get complex if you're thinking about them in each bucket. Eventually, the goal here is you can make up your own ways to get to variances. All variances are doing is we're determining the different types of variances between between products we sold or costs we're incurring, and we can do that. We can calculate that in an innumerable amount of ways, right? As a manager, you can get creative with on how you can determine variances. These are just the most common types. And so again, don't stress too much on these variable variances though, but I think it's just, I wanted you to be exposed to the topics because they're extremely helpful in understanding the different ways that you can reach the variances. And then you can also see how easy the direct material and direct labor variances are themselves. And I think these last slides are kind of a good summary of all the different types of variances, and you can see what's given versus how they're calculated, right? Like actual overhead's given, budgeted overhead will be given. Only calculation here is our applied overhead, and then we can figure out our variances. For variable overhead, actual overhead's given, and then we calculate the applied and the middle piece. And then we can just see our journal entries. We'll walk through those relatively quickly. Standard cost accounting system. Let's see the entries for one recording. So if we're using a standard costing system, we're always going to be applying our journal entries at standard cost. And then if we spend more money or we use more products than we thought we would, we'll just have journal entries to increase the side of the entry that says that, hey, we used more product, we'll debit it if we have a variance that's unfavorable, or we'll credit the product if it's favorable. And so here we had an unfavorable, we thought we were going to use 35,000, but we had an unfavorable price and quantity variance. And so we debited both of those to move into our work in process inventory. And these appendixes are going to be not on your final, and they'll just be tested very limited. Just want you to see the full picture here. Work in process, 56,000. Debit, we had an unfavorable labor variance, so we had 1,700 for the. These all tie to your other slides as well. 1,700 rate variance, unfavorable, that we add to this, and a favorable efficiency variance, which you subtract to get our wages payable. Same thing here. We have our volume and overhead spending variance and our overhead efficiency variance. If it's unfavorable, it's going to increase our work in process inventory because we spent more. If it's favorable, it decreases our work in process, and ultimately backs out of our factory overhead that we're applying, right? Because we apply factory overhead. And then all of that would be shown here on that first sheet we showed at the very, very beginning on what it would look like from a standard costing standpoint. We talk about all the different variances to get to our total cost variance. And the whole reason for finding these variances outright is so that we can figure out how to manage our company better. The more detail we have, the more we can drill down into finding out where our issues are. A lot there. I'll open it up for questions.